Hi there, Bev and Rob. Further to our meeting earlier this week, I've put together a little suggested video in very much draft form at this stage to explain the difference between tax-free investments and retirement funds. And the idea is that you have a look through this and see whether I'm in the right direction. Then we would put it onto Sanlam branded slides and make the final video of it. It goes something like this. In the budget this year, there was an announcement that South Africa will again receive tax-free investments. This has been very popular, particularly with grannies who remember the old days when we used to receive tax-free savings accounts from the post office. And people believe that having a tax exemption is an integral part of being able to build wealth. Let's have a look at it because a lot has changed since the old days when we had post office savings accounts. It goes like this. When you invest in tax-free funds, we're saying that you are able to invest post-tax income after you've earned it, and you will receive tax exemption on the interest income of your fund. There will be no dividend tax deducted from your dividends, and there will be a CGT exemption when you sell the fund. And that looks very attractive. But we have to look at it in various contexts because there are other exemptions and other developments. Let's start off with what's happened with interest rates. Those who remember tax-free savings accounts are remembering the good old days when the Reserve Bank was run by Dr. Chris Stotz, and the interest rate was 10% above the inflation rate. And in those days, there wasn't really much to the debate. You simply put your money in an account and it grew tax-free at above the inflation rate. But things have changed since 2000. While Tito Mboweni was head of the Reserve Bank, he brought the interest rate down to approximately the inflation rate, and this was followed by Jill Marcus, who took the interest rate even below the inflation rate. That trend will continue under the new head of the Reserve Bank. Let's also take into account that tax-free investments are not the only tax breaks that you get. Every taxpayer gets an interest-free allowance every year. If you're under 65, that's 23,800 Rand, or over 65, 34,500 Rand. You can also receive 30,000 Rand of tax-free capital gains every year. If you haven't filled up these exemptions, the tax-free instruments only provide an advantage in respect of dividend tax, and that difference is going to be tiny. So let's have a look at a tax-free investment summary. Yes, you can buy these tax-free investments. Contributions are limited to 30,000 Rand per annum or 2,500 Rand per month, with a total lifetime contribution ceiling of 500,000 Rand. If one looks at the contribution limits, they do not include the returns that you get on your investments or transfers between tax-free investments. And there's no limitation on the withdrawals of your investments. You can do so at any time without a negative tax implication. But you need to compare this to retirement funds. When you invest in a retirement fund, you are getting a tax break of up to 40% of the contribution when you submit your tax return. Yes, these limits will be capped in 2016 at 27.5% of taxable income or 350,000 Rand a year, but those allowances are quite generous. But retirement funds then enjoy the same tax exemptions on income as you would enjoy in a tax-free instrument. And on top of that, you will also get a retirement fund proceed exempt from both capital gains tax and estate duty. Yes, there's an income tax implication on the ultimate withdrawal from a retirement fund, but that can be managed. So let's do some calculations. So using a Sanlam calculator, you're saying, I'm investing 2,500 Rand per month with growing that contribution by 5% per annum. I'm going to do that for 20 years and assume a net growth rate of 10%. That will accumulate 2.5 million Rand over 20 years with a 6% inflation rate. That's worth 802,000 Rand today. But if I did the same calculation and I said instead of investing in a tax-free instrument, I'm going to invest in a retirement fund, I would look something like this. Yes, I would get the same growth of my money while it is in the fund, But if I then reinvested my tax savings that I'm going to achieve from being in that fund, and they can be as much as 41% of the total contribution, then I'm going to build up a second fund, and that in this instance is a further 329,000 Rand after 20 years. So my maturity value would be in the region of 1.1 million, not 802,000. So we have to take that and we have to say, well, how does this fit into retirement planning and financial planning overall? And we go like this. We say there are 4 objectives in a financial plan. You start off ensuring your life and your sickness benefits. Then we talk savings accounts, which are very small in today's terms because interest rates are lousy. Then we have investments, which are subject to taxation, and they are accessible before you are 55. And finally, we have tax-subsidized retirement portfolios, which are assisting you for the day that you retire. So, if you are a younger person, one is looking to go heavy to insurance to make sure that you are safe. And if you're a little bit older, you'd be going heavy to retirement funds to provide for that ultimate day. When we put this into a lifestyle scenario, we say, what are the lifestyle issues? And we say, yep, you get born and you spend 25 years getting educated and graduate. You then say, what is the biggest event after that in your life? And believe it or not, the biggest events are going to be when you retire, 40 years plus after you've graduated, and then living from the date that you retire until you die. In between that are the secondary objectives, the romantic ones as I call them, which are finding your spouse, cars, toys, property, and kids. Then you're going to have the issue of your parents and in-laws and their retirement and possibly coming to live with you, and ultimately you might have to pay for your grandchildren as well. Those are the other smaller issues that we have to bring into a financial plan. If we look at the smaller issues, they are issues that will happen to you before you are 55, and if you're saving towards those goals, you will want to use tax-free investments simply because you cannot access retirement savings until you achieve the 55-year-old benchmark. Thereafter we say, well, the big objectives are to live safely in retirement. We want a tax subsidy on that through a retirement fund, and there a retirement annuity will certainly outperform a tax-free investment. I'm Matthew Lester at the Rhodes Business School. Thank you for your attention. Right, so that's the basic lineup. What do you think so far? Thanks a lot, Matthew.